In this video, we're going to look at the account called Allowance for Doubtful Accounts. Allowance for doubtful accounts represents a company's estimate of the amount of uncollectible accounts receivable. So this is how much the company thinks they will not be able to collect from their credit sales. This account is a contra asset account, which means the balance is opposite of that of an asset account. Contra asset accounts are always tied to asset accounts, so they're always shown together with the asset account. The asset account that allowance for doubtful accounts is tied is the accounts receivable. So in your balance sheet, when you report accounts receivable, you're going to show accounts receivable, and then you're going to subtract the contra asset account of allowance for doubtful accounts, and then you're going to report the net realizable value of accounts receivable in your balance sheet. The allowance for doubtful accounts has multiple names. So if you see the term doubtful accounts, if you see the term uncollectible accounts, or if you see the term bad debts, it means the same thing. So it'll be called allowance for doubtful accounts, allowance for uncollectible accounts, or allowance for bad debts. There's always going to be an expense tied to this as well, and you'll see the same three names applied to the expense as well. When a company uses what we call the allowance method, that is when the company reports accounts receivable in the financial statements at net realizable value. There is another method called the direct write-off method, and we will not be covering it in this course. When the companies use the allowance method, bad debts have to be estimated. We're going to learn about three methods of estimating these bad debts. Once a company has estimated the bad debt, to record the bad debt, they're going to record it as an adjusting entry. The adjusting entry is that they are going to increase the doubtful account expense. So you will have a new account that you're going to learn called doubtful account expense. That is an expense account just like salary expense, rent expense, and so on. And then it's also going to increase the allowance for doubtful accounts, which is the contra asset account that we just learned about. The adjusting entries, as you recall, are done on the last day of the accounting period. You may want to note this down because when you are recording your bad debt expense at the end of the accounting period, the adjusting entry always has to be this: increase doubtful account expense and increase the allowance for doubtful accounts. Again, your homework doesn't have a column called allowance for doubtful accounts. They have a column called net realizable value of accounts receivable. So whenever allowance for doubtful accounts increases, your net realizable value of accounts receivable decreases. Allowance method is consistent with the matching principle. We talked about the matching principle before. That's the one that says during a period, we need to measure all the expenses related to earning revenue and then record it in that same period. Well, think about an accounting period, which is a year. If the company earns revenue of $100,000 during that year, and then they have a $1,000 bad debt where a customer doesn't pay that amount, that $1,000 bad debt is related to the $100,000 sales they did that in year. So the company may not know that there's a bad debt until year 2 or year 3, but that $1,000 is an expense related to the $100,000 of sales we did in this particular year. So the company has to estimate how much the bad debt is. So it won't be exact. They will estimate how much the bad debts will be relating to this particular year's sales and then record that estimate as an expense. We're going to do several examples so that you can see how that is done, but just know that that is what the matching principle says, and that's consistent with the matching principle. If we wait until the bad debt is realized or the bad debt actually occurs, then we're not following the matching principle. Therefore, Matching principle is part of GAAP, and whenever we follow GAAP, it requires the allowance method to be used. In the next series of videos, we'll look at how to estimate the bad debts using the 3 different methods and how to record it in your horizontal financial statements model. That's it for this video.